Welcome to the Trade on the Market. I'm Thomas, and in this video, I will cover the most important macroeconomics data releases for the week ahead and explain their potential impact on the financial markets. And at the end of this video, I will walk you through on what is the mysterious reason that banks are going bankrupt nowadays. But before that, we will check the upcoming events. So I'd say that we are starting on another calm Monday, but just like last week, there is some market panic knocking on the door due to the ongoing bank drama. Despite not many macro data releases on Monday, we may see aggressive trading volume once again. We'll see. On Tuesday, however, we will be facing more significant events than just Canadian inflation data that could affect the Canadian dollar, by the way. We will also have US existing home sales data, which can be an essential indicator for us. And well, let me explain why. The US existing home sales is a monthly report released by the National Association of Realtors, so NAR, that provides information about the number of previously owned homes that were sold in the previous month, as well as their prices. This report can give investors and traders insight into the current state of the housing market and how many people are interested in buying or selling homes. As with any market, supply and demand is a key factor, and changes in home sales can indicate a strength or weakness of the economy. The report can also have an impact on related industries, such as construction and home renovation, and can serve as an important economic indicator in these sectors. Currently, existing home sales in the United States have reached historic lows, with only 4 million homes being sold, which is a sign that people are not buying homes at a rapid pace. This could potentially lead to problems with mortgage payments in the future. Any decrease in the previous month's data is negative for the economy and therefore for the DXY as well, which is an important consideration for forex traders. In summary, the US existing home sales report provides valuable information about the state of the housing market and can be an important indicator for the overall health of the economy. Forex traders should take this into consideration when selecting currency pairs for trading. By the way, if you want to learn how to properly select currency pairs, you should visit our website and after that our Discord server, because we have very good education material in this topic. And now we have just arrived at the eagerly awaited Wednesday when the wild animals arrives. It will be revealed whether Jeremy Powell will raise interest rates or not. But first, an inflation data will arrive from the sinking ship of the United Kingdom, followed by crude oil inventories from the United States, and well, we can jump into the pie, by the way. So we will have some news at 7 p.m. Central European Time. It's not just the interest rate that will be interesting, but also the press conference after that. We need to know not only if the bank's nightmare continues, but also the Fed's stance on that matter. The Fed is in an interesting situation depending on how many banks need to be bailed out in an unconventional way, which I'll explain later why unconventional. But it needs money anyway. However, it's unlikely to do money printing while raising interest rates at such a high inflationary environment. At the same time, the rate cut is also unlikely in such a high inflationary environment. So many are now expecting a 25 basis point cut, but that's practically like jumping out of an airplane with an umbrella at 3,000 meters. Furthermore, the ECB sent a strong message to the Fed last week with the promised 50 basis points increase. There's no mercy in Europe, and banking issues are not being treated the same way as inflationary issues. And that's the right decision. If interest rates were to be cut, it would have to be done drastically and very quickly near zero. Otherwise, implementing an easing monetary policy in such a tense situation would be impossible. However, this would cause instant hyperinflation, so personally, I don't think it's very likely. But Powell may refute this later, because never forget the movie Don't Look Up. I wouldn't be surprised. What's more important now is the traders' reaction. Two scenarios usually happen at times like these. There is a situation in the Game of Thrones when the Night King is approaching and everyone gets some amount of frozen, unpleasant waste inside. Then a small nuclear flash is expected in terms of volume at 7 p.m. Central European time. The other scenario is that the market becomes nervous hours before 7 p.m. and fluctuations are expected in all directions, then a big surge after 7 p.m. and the market goes to sleep until evening. Whichever scenario plays out is great information for an intraday trader to choose the strategy for the day, which will probably be momentum following, or at least I would recommend to do so. Personally, at times like these, I just watch and let others destroy their nerve system and then act if necessary and of course if there's any opportunity at all. And well, here is Thursday, which will not be boring at all, especially with a new player entering the spotlight. The Swiss National Bank. In addition to that, we will keep an eye on the UK interest rates, US unemployment data, new home sales, and natural gas storage data. For now, Switzerland and US unemployment claims are the most important news. The Swiss National Bank, so SNB, sets the benchmark interest rate that banks can borrow or deposit money with the SNB, including Credit Suisse. The SNB's governing body determines the rate to regulate inflation and maintain price stability in the Swiss economy, but not to maintain Credit Suisse. And let's agree on that it is not very maintainable anymore. The SNB's interest rate is important because changes in the interest rate can have a significant impact on the Swiss financial market, including the value of the Swiss franc and Swiss credit and loan interest rates. And of course, impacting Credit Suisse. A change in the SNB policy can signal its stance on the economy and future monetary policy decisions, which can affect investor sentiment and market expectations. If the SNB raises interest rates, everyone will be very unhappy, including Credit Suisse. Therefore, investors interested in Swiss financial markets and economy must closely monitor the SNB benchmark interest rate and any changes to it. Why? Because the SNB is about to kill Credit Suisse with only one finger in case it raises rates. By the way, the largest Saudi support bank withdrew its support for Credit Suisse, which means that the bank is hanging on by a thin string to avoid a financial collapse. It remains to be seen whether the Fed will respond to the bank's collapse or not. Previously, it saved the bank with $9 billion, but this time, even a rescue package would only save depositors and not the bank itself. However, the importance of Credit Suisse is global, so a hike in the SNB's interest rates could effectively kill the bank. So this will be a very important time to watch. On the other hand, I just got a news this morning that there is another bank which is really interested to buy Credit Suisse, so a very, very interesting week is ahead of us. And the other one, in response to the previous UK CPI figures, the Bank of England is making decisions about further interest rate hikes. There are more banking problems in the kingdom than elsewhere, which raises questions for me about what the Bank of England will do. I don't have any predictions about the outcome right now. It would be foolish to have any. However, I have developed several plans for different scenarios, mainly targeting UK 100 index. Paying attention to both the possibility of interest rate hikes and the scenario where the BOE doesn't change rates. I don't think it's going to happen, but I have to plan with it, because it's possible. Since the UK 100 has suffered drastic losses in recent trading days, it's not difficult to determine the direction of momentum, but stagnation could be a disturbing factor, so I expect a short period of stagnation only, if there will be any. And of course, as a strategy, following the momentum, it should be easy for me. And now, US unemployment claims. The increase in unemployment claims 2 weeks ago made traders uneasy, and if it had continued to rise, it would have confirmed to the Fed that their policy of raising interest rates to slow down economy was successful. However, this did not happen. I have mentioned this in the past few months as well. Despite the current situation, I still think this data plays a crucial role in interest rate hikes, and it's more important to the Fed than pressure from the banks to cut interest rates up to a certain point. That point is when the entire banking sector collapses. Until then, an increase in unemployment claims would be a positive feedback. A decrease, on the other hand, signals that fewer people are filing for unemployment, which combined with increased employment data will almost certainly trigger aggression from the Fed. Unfortunately, this happened last week. We fell back to 192k, which is terrible news for those who wanted a rate cut because it will only trigger more aggression from Powell. This is actually our anomaly data, since the decrease has a positive effect on DXY, not the increase. However, we must not forget that previous market crashes leading to recessions have always been accompanied by rising unemployment. So these data also serve as a prediction that if it rises rapidly, we will know the scenario. It's pretty evident, but it's always better to have a number to support it. And now let's jump to the last day of the week. On Friday, there are many important data releases, so I was thinking which one to include in this video. We have British retail sales, German and Eurozone composite PMI data, and US data. So I decided to focus on the German and Eurozone PMI, and you can find the rest at the pro level. So for now, I'll bring up the German manufacturing PMI data. Currently, it shows safely contained values, which is fine. The reason I'll be watching it is that there is a heavy pressure on the ECB due to banking problems, which could lead to desperate decisions if the situation worsens, which would impact the economy. In that case, I need to see how significant this will be in the German economy. Obviously, it won't be visible in the next data, but I'll keep an eye on it. The other important reason is the German automotive industry, which plays a significant role in the European stock market. I'd like to note that this data needs to increase to stabilize the automotive stocks. I don't expect this data to rise above 50 points soon, but it's worth paying attention because a 2 to 3 months above 50 points closing is evidence of better performance, resulting in improved revenue data for companies, which lead to better earnings per share numbers. And this is what makes the company stocks attractive in the first place. Therefore, this is the data that can provide us with first-hand forecast for the European automotive company stocks. And the other one is the European producer data, which is important now because of the DAX. Just like with the German data, I wouldn't expect any changes here. However, the DAX has fallen the most in the last 2 weeks, so we need to pay attention to this data as an indicator. Similarly, an above 50 points value for 2 to 3 consecutive times would be very good news for the DAX. But realistically, we should expect the data to stay roughly at this level, so about 48.5, which will continue to fuel short sellers and sellers most probably. And now, let me explain why banks are going to bankrupt, not in general, but why they are going bankrupt even if they have a lot of depositors. So the sudden inflow of money after 2020 was very beneficial for banks as they were able to grant a lot of loans and attract depositors. They took advantage of the situation and money poured into them in 2020 and 2021. Of course, loan repayments also provided even more profits. The banks used the profits and deposits to purchase long-term bonds because they cannot keep that much money on hand and also try to earn some extra interest on it. As a result, bond prices soared while central banks kept their interest rates drastically low, some countries even close to zero, like Hungary. Due to the high bond prices and relatively cheap dollar, stock prices skyrocketed, which was further accelerated by the huge amount of money that flowed into the stock market at that time thanks for the worldwide stimulus. As a result of the disrupted supply chain, there was high inflation that kept rising and couldn't be stopped. At the same time, the prices of stocks rose rapidly due to the large amount of money that flowed into the stock market, but eventually it was time to put an end to the party. And here is our man who did so. The central banks followed an aggressive interest rate hike to combat inflation, which was initially alarming, although the pace already indicated that the Fed, for example, was raising rates faster than ever before in history. This already scared the banks. They had made some mistakes. Well, some serious mistakes. Along with the interest rate hikes, Bond prices began to drop sharply, but due to their long-term maturity, banks did not have access to many of them. What they did is to have access to what was worth less than when they bought it. And this was the first sign that they were feeling the impact of the very, very big problem. At the same time, due to high inflation and interest rates, people started to withdraw their money from banks. This is a natural process as during an inflationary period, cash is a king, and the US dollar demonstrated this as it began to soar. Well, but the banks didn't have enough cash to pay out the people withdrawing their money due to high inflation and interest rates. So to make up for this, they had to sell the available bonds they had bought earlier. However, bond prices had dropped significantly and banks lost a lot of money. This made the banks unable to pay their debt, even though they had been handling a huge amount of deposits. The deeper the bond fell, the worse the situation became, and at one point the process became irreversible. The result of this was the bankruptcy of the banks. Meanwhile, the Fed had no intention of repeating 2008, given that rescuing banks would require printing a huge amount of money later on, which is impractical during a high inflation. However, they created the BTFP, or Bank Term Funding Program, which involves taking over the bank's devalued bonds and providing the banks with a one-year loan that can be used to pay the amounts demanded by their customers. It's important to note that this loan is only valid for 1 year, so the bank has that much time to get its affairs in order. And this will depend on many factors, such as the length of the interest rate hike period. So this is not a guarantee that the wave of bank collapses will not continue in 1 year time, but by then, the more stable banks may be able to buy them more easily. In addition, this move by the Fed could still have an inflationary impact, so it's not a good solution, but it's probably the lesser of two evils. So technically, this is what's happening with banks nowadays, and overall the stock market had a very, very sad week. There were mixed sectors such as the tech companies, but over 50% of them closed negative. Healthcare companies had similar performance. Companies producing non-durable consumer goods had a pretty good week, but there wasn't any particularly positive performance. However, they managed to react well to the DXY's decline on Friday and closed the week on a good note. This can also be said for the utilities sector. However, besides that, the entire market closed severely negative with a high percentage over 3% losses. Therefore, the breakout from the bearish flag on the S&P 500 finished the retest, and on Friday, despite the falling DXY, it closed negatively. The fact that the DXY was falling is telling about the huge momentum to the downside on Friday. And please don't forget, the current movement is a bearish flag again, so you can guess what. The Russell suffered terrible losses as well. And on Friday, it stalled at the local resistance level of 1722.95, but now we have a new low below level, which is an important message for us in terms of price building to the downside. If you want to learn about price building, downside and upside, doesn't matter, just visit our website because we have very good material about that topic. The UK 100 is also a very similar and drastic situation. The extent of the correction would be still healthy, but from a price building perspective, the downward trend is already not reassuring. Moreover, the break on the daily timeframes 200 EMA and its sudden but successful retest clearly show the unstoppable selling wave that currently dominates the market. The only market that managed to perform slightly better this week was the Nasdaq, which bounced up from its zone. However, Friday was not a good day for it either, and in addition, it broke out of its bullish flag, which could have been great for intraday traders, but looking at the heat map, it's not surprising that only 3 of the larger tech companies, so it's like Google, Microsoft and Meta, provided relatively acceptable performance. The others closed the weekly slightly positive, but mostly negative, and these 3 giants were enough for the Nasdaq to have a slight increase. It will be interesting to see how it performs next week. Overall, the crypto market performed positively this week, and although the volume wasn't very high, the total market cap moved into a very important zone by showing a new higher high level. With Signature Bank reporting bankruptcy, the transfer of the USD to and from crypto brokers in the United States is becoming a bigger problem, leading to most people deciding to leave their capital within the market instead of withdrawing it. This has led to positive reactions in European and Asian trading because these regions haven't experienced such problems yet. The upper resistance level of the zone is at 1.26, and if the crypto market rises above this level, it will entering a positive territory or a bull trend if you like so. However, it is important to note that the crypto market is sensitive to DXY. This week, DXY had negative performance on most days, so the rise of crypto assets wasn't a hard job. But it will be important to watch the closing of the DXY cycle, the decision on Fed interest rates next week, and the reaction of DXY to it. I'm hoping for good performance, and our pro members can tell you more about how it was nicely to scalp this week. I hope the information was useful for you. Remember, at the pro level, we analyze every major market data and draw a proper conclusion when they arrive. If you want to join, visit our website, link in the description. In the meantime, I would like to hear about your thoughts and opinions in the comment section. If you want to stay informed about next week's data and other useful information, subscribe and turn on all notifications. And if you enjoyed the video, give us a thumbs up so it can reach more people. See you in the next video. Bye.